So imagine the entire economy of a country, a massive, rapidly growing nation like India, is basically a high-speed bullet train.
Oh, okay, I can picture that.
Right. And the central bank, so the Reserve Bank of India, they sit up there in the engine room, and they've got this big lever.
Yeah, the monetary policy lever.
Exactly. So they pull it forward
Mhm.
to, speed the economy up by lowering interest rates, or they pull it back to slow things down if they need to fight inflation. It sounds incredibly powerful, right?
I mean, it is powerful, very powerful.
It is. But here's the terrifying part. What if the tracks beneath that bullet train are broken? Or, what if there simply aren't any tracks at all?
Well, in that scenario, it really doesn't matter how hard you pull that lever. I
Hmm.
mean, the engine revs, sure, but the train goes nowhere. Or, worse, it just derails entirely.
Right. The lever is totally useless without the infrastructure to carry the momentum. And that infrastructure, the literal steel tracks beneath the economy, is the financial market. So, welcome to this highly tailored deep dive. Today we are taking a really microscopic, exhaustive look into exactly how those tracks are built, how they're maintained, and heavily guarded. We are tearing apart the Reserve Bank of India's official framework, specifically focusing on Chapter 12, Development and Regulation of Financial Markets.
And I have to say, it is a phenomenal piece of source material. Because it doesn't just, list out the rules today. It explains the entire philosophical shift of a nation.
Yeah, the whole history.
Exactly. It covers decades of evolution, all these intricate and, frankly, sometimes intimidating financial instruments, and this massive web of regulatory architecture that most people, they never see it, but they interact with it every single day.
That's the crazy part to me. This stuff feels invisible to the average person, but it dictates everything. And our mission today is to decode it completely.
Right. No skimming the surface today.
No skimming. Today's deep dive is designed as an ultimate audio-based study guide. We're creating a blueprint for you that is so detailed, so exhaustive, that you won't even need to reread the chapter to master the material.
We're doing the heavy lifting for you.
We really are. We're going to dissect the core concepts, map out the timeline, define every single crucial piece of jargon, profile the institutions, and map out the cause and effect relationships. Because by the end of this, you are going to understand the plumbing of global capital so thoroughly, you'll never look at a bank loan or a currency exchange rate the same way again.
Because at its core, this is the ultimate shortcut to understanding how money moves globally. I mean, financial markets are the vital plumbing. If you understand how the pipes connect, you basically understand the whole economy.
Okay, so let's start with the biggest, most overarching concept in the entire document, our core concept.
Yeah.
If we had to give this whole story a title, it would be From Repression to Resilience.
I like that. It really captures the arc.
Right. That's the big picture. The RBI basically operates with a dual mandate in financial markets. On one hand, it actively develops the market infrastructure, making capital raising efficient,
Right.
but simultaneously, it regulates it to ensure stability and fair conduct.
And that dual role, it's absolutely crucial to understand. Because not every central bank in the world does both to this extent.
Wait, really? I assume they all did.
Not always, but here, in a market-oriented policy environment, the financial markets are the literal transmission mechanism. Like, if the RBI changes its policy rate, the repo rate, that is just a theoretical number on a piece of paper, unless there is a deep, highly liquid market to actually transmit that new rate into the real world.
Okay, so going back to the traffic grid analogy, you can't just build faster cars, which is the monetary policy. You have to build wider, safer highways, which is the market development.
Yes, and you have to install functional traffic lights, which is the regulation side, to prevent everyone from crashing.
Perfect. But the text points out this transition matters to you, the listener, because the efficiency of these exact markets directly dictates the interest rates on your loans and your savings. But it wasn't always this open, dynamic system, right?
Yeah.
Before the 1990s, India had what the text calls a repressed system.
Right, financial repression.
What does that actually look like on the ground?
Well, financial repression means the market was effectively a captive audience. It was driven almost entirely by the fiscal compulsions of the government.
Meaning the government needed to borrow a ton of money, and they didn't want to pay a fair market price for it.
Precisely. In a repressed system, interest rates are what we call administered, meaning the central bank or the government just dictates what the rate will be by fiat.
So no supply and demand.
None. There is no true price discovery. The government needed to fund its massive deficit, so the system was legally rigged. Commercial banks were forced to buy government debt at artificially low fixed rates.
Wow. It's like going to a restaurant where the menu only has one item, the chef tells you exactly what you're going to pay for it, and the doors are locked, so you literally can't eat anywhere else.
That is a very accurate way to picture it. It was a completely closed loop. Credit was rationed. Foreign exchange was heavily controlled.
So if you're a business wanting to expand, what do you do?
You couldn't just go to the market and buy dollars or raise capital at a market clearing price. You had to navigate this insane labyrinth of permissions. And often, the capital just wasn't even available because the government had soaked it all up.
Okay, which brings us to how we actually broke out of that lost restaurant. This transformation didn't just happen magically overnight. It was meticulously engineered. So let's trace that timeline, the chronology, because seeing the evolution helps explain the modern rules.
Right, the historical context is everything.
So the pre-1990s was the repressed era. But the real sparks of reform started in the 80s, right? The text highlights two foundational committees, the 1985 Chakravarti Committee and the 1987 Vogel Committee.
Yeah, those two committees really laid the intellectual groundwork for everything that came later. They looked at the repressed system and said, this is completely unsustainable.
They saw the writing on the wall.
Exactly. They basically told the government, look, we cannot continue with a command and control financial system if we want this economy to actually grow and integrate with the world. They heavily advocated for developing a proper money market and systematically moving toward market-determined interest rates.
They said, let's unlock the restaurant doors.
Yeah.
And that triggers this incredible window from 1986 to 1992, which the blueprint calls the money market boom. Suddenly, the RBI is just rapidly introducing all these new instruments. We get treasury bills, certificates of deposit, commercial paper, and repos.
It was an absolute explosion of financial infrastructure. They were finally giving market participants, so banks and large corporations, the actual tools they needed to lend and borrow short-term funds.
But tools aren't enough if the prices are still fixed by the government, right?
Right, which is why 1989 is the true watershed moment highlighted in the text.
What happened in '89?
That was the year the RBI finally removed the interest rate ceilings on the interbank call and noticed money markets.
Okay, so they finally took the artificial speed limits off the highway.
Exactly. For the very first time, the price of short-term money in India was determined by actual supply and demand between banks. If cash was scarce, the rate went up. If the system was flush, it went down. It was the birth of true price discovery.
Okay, so they fixed the short-term borrowing market. But then we hit the early 90s, specifically 1991. And this next phase, the Forex revolution, this wasn't just a planned academic rollout. This was forced by pure panic, right?
Oh, absolutely. It was an existential economic crisis. The 1990 to 1991 Gulf crisis caused global oil prices to absolutely spike. And for India, which imports the vast majority of its oil, this just devastated the balance of payments.
Okay, let's break down balance of payments for a second. Sounds like boring accounting jargon, but the reality was terrifying.
Imagine the national bank account for foreign currency. You need dollars to buy oil on the global market. India was spending dollars at a massive rate to afford this suddenly expensive oil, but it wasn't exporting enough to earn those dollars back.
So the reserves were just bleeding out.
Hemorrhaging. It got to the point where India had barely enough foreign exchange reserves to cover like a few weeks of essential imports. The country was basically on the brink of a sovereign default.
I mean, the stories from that time are wild.
Yeah.
The government literally had to airlift physical gold reserves to London just to pledge as collateral for a loan to keep the lights on.
Yeah, it was a severe reckoning. And it forced the realization that artificially fixing the exchange rate of the rupee was a luxury they could no longer afford. So enter the high-level committee on balance of payments, chaired by Dr. C. Rangarajan.
And what did they say?
They recommended a drastic immediate shift towards a market-determined exchange rate.
Because defending an artificial price was just burning through their precious dollars.
Exactly. This led to a transition phase in 1992 called LERMS, the Liberalized Exchange Rate Management System. It was a dual exchange rate system. A portion of foreign exchange had to be surrendered at an official rate, while the rest could be converted at a market rate.
Like training wheels.
Yeah, a stepping stone to test the waters without causing an absolute shock to the system.
But the training wheels didn't stay on very long, did they?
No. By March 1993, just a year later, India moved to a completely market-determined exchange rate system. The value of the rupee was now decided by the millions of transactions in the Forex market rather than a government decree.
That is a monumental shift. Okay, so moving down our timeline into the late 90s and early 2000s, the instruments are in place. Floating interest rates, floating currency. Now the RBI enters the phase of truly building the infrastructure. In 1999, they introduced derivatives, interest rate swaps, or IRS, and forward rate agreements, FRA. Now, I know some listeners might groan at the word derivatives because of 2008, but why were these necessary?
Well, because floating rates introduce a brand new danger, which is volatility. Once you have market-determined interest rates, you introduce interest rate risk.
Give me an example.
Sure. Imagine you're a massive infrastructure company building a dam. You take out a huge loan with a floating interest rate. If macroeconomic conditions change and rates spike from, say, 5% to 10%, your project is suddenly totally bankrupt.
Right. You can't plan for the future if you don't know what your money is going to cost you.
Exactly. So an interest rate swap allows that corporation to manage that risk. They enter a contract to exchange their floating interest rate payment for a fixed one, transferring the risk to someone else willing to take it. It was a huge sign of a maturing market. You aren't just trading money anymore, you're trading the risk associated with money.
And then in 2001, we see perhaps the most monumental infrastructural achievement in the text, the establishment of the Clearing Corporation of India Limited, CCIL. We'll dig into exactly how they act as a shock absorber later, but 2001 is a massive flag in the ground.
Oh, it profoundly changed the entire risk profile of Indian financial markets.
Okay, then we hit 2003, the fiscal shift, the passing of the Fiscal Responsibility and Budget Management Act, the FRBM Act. The sources emphasize this heavily because it ended the automatic monetization of debt. We need to unpack that phrase because it sounds dry, but it's really about the government's addiction to printing money, right?
Yeah. Automatic monetization of debt is effectively a magic money tree for the government and an absolute nightmare for the central bank.
How did it work?
Before this act, whenever the government spent more than it earned, which was always, they would issue these ad hoc treasury bills. They'd basically write an IOU, hand it to the RBI, and the RBI was legally obligated to just credit the government's account with freshly printed money.
Wait, so the government didn't have to convince any actual investors to buy their debt. They just forced the central bank to invent the money out of thin air.
That is exactly what happened.
But doesn't that just violently dilute the money supply and cause rampant inflation?
Yes, it completely robs the central bank of its primary weapon, which is control over the money supply. You can't fight inflation if the government forces you to print billions of rupees every quarter.
Right. So ending that with the FRBM Act in 2003.
It forced the government to face reality. If they wanted to borrow, they had to go to the open market, they had to issue bonds and convince banks and mutual funds to voluntarily buy them at a competitive, market-determined rate.
That's a massive catalyst. If the government suddenly has to sell all this debt to the public, they have a very strong incentive to make sure the government securities market is incredibly efficient.
Precisely. It forced financial discipline and it turbocharged the deepening of the bond market.
Okay, that brings us to our final historical era, 2006 to the present. The pace of sophistication really accelerates. In 2006, when issued trading and short selling. In 2010, strips. From 2017 to 2020, the Legal Entity Identifier, or LEI system. 2018 brings the electronic trading platform's directions. And most recently, this massive push for retail access via the FX Retail Platform and Retail Direct scheme.
It's an incredible journey. From a closed, repressed system where a bank manager was told exactly what to buy, to a digital ecosystem where an individual retail investor can just pull out their smartphone and buy a 50-year sovereign bond.
But to operate in that modern ecosystem, you need to speak the language. And frankly, finance jargon can feel like it was deliberately designed to keep normal people out.
It really can.
So let's break down the terminology. Let's build that exam-ready glossary from the source material, starting with the money market. Let's unpack this.
So the money market is all about short-term liquidity. It's how institutions manage their day-to-day cash needs. And the most liquid of all money market instruments is call money.
The text defines call money as uncollateralized lending and borrowing of funds for exactly 1 day, overnight. Now, I understand the 1 day part, but why would a multi-billion-dollar bank need to borrow money for literally 24 hours?
Well, imagine a massive commercial bank. Throughout the day, millions of transactions happen. Deposits come in, massive corporate withdrawals go out. By law, at the end of the day, that bank must maintain a certain percentage of its deposits as cash reserves with the central bank.
Okay.
The cash reserve ratio.
Okay, the safety buffer.
Right. Now imagine it's 4:55 p.m. A huge corporate client suddenly withdraws 500 crore rupees to fund an acquisition. Suddenly, the bank's cash reserves drop below the legal minimum.
Uh-oh.
right? They don't have time to sell off assets. They just need cash right now, overnight, to balance their books for the regulators. So they call up another bank that happens to have excess cash that day, and they borrow it overnight.
And the text says this is uncollateralized, meaning no asset is backing it up. Bank A isn't giving Bank B a bond to hold on to just in case. They're literally just wiring the money based on trust.
Exactly. It relies entirely on the pristine credit rating and trust between the participating banks. I mean, if you default on a call money loan, you are effectively excommunicated from the financial system.
High stakes. Okay, the next two terms are variations on that same theme, notice money and term money.
Correct. Notice money is the exact same concept, uncollateralized borrowing, but for 2 days up to 14 days. Term money extends that horizon further, from 15 days up to 1 year.
Okay, so call, notice, term. All uncollateralized, just a handshake and a great credit score. But what if you aren't a massive, completely trusted bank? What if you want to borrow money, but the lender wants some security? That brings us to the heavy hitters. Repo and reverse repo. These drive the entire system. What is the actual mechanic of a repo?
Repo stands for a repurchase agreement. It helps to look at it from the perspective of the borrower. Imagine you hold 100 crore rupees worth of government bonds, but you need cash today to fund operations. You can't just sell the bonds because you want them back as a long-term investment.
Right.
So you enter a repo. You sell those bonds to a lender today for cash, but embedded in that transaction is a legally binding contract to repurchase those exact same bonds back from the lender on a specific date in the future at a slightly higher price.
It's like a pawn shop for billionaires. I give you my Rolex, you give me cash. A week later, I give you the cash plus a little extra fee, and you give me my Rolex back.
That is a phenomenal analogy, actually, yes. The Rolex is the collateral. The difference between the price you sold bonds for today and the higher price you buy them back for next week represents the interest on the loan. So in a repo, you are borrowing funds and providing securities as collateral.
And a reverse repo is just the person standing on the other side of the pawn shop counter.
Exactly. If you are the lender, you are executing a reverse repo. You are buying the securities today with an agreement to sell them back later.
Now, the sources make a very specific builded distinction here between LAF repo and market repo. What is LAF and why does it matter who I'm doing the repo with?
This is a crucial nuance. LAF stands for Liquidity Adjustment Facility. A LAF repo is a transaction that happens directly with the Reserve Bank of India. When the RBI wants to inject cash into the entire banking system, they conduct a LAF repo. The RBI buys bonds from the banks and gives them cash.
So that's the central bank pulling the lever.
Right. The interest rate at which this happens is the famous repo rate you hear about on the news. It's the primary tool for dictating the cost of money in the economy.
Got it. And a market repo?
A market repo is a transaction that happens horizontally between two market participants, like Bank A borrowing from Mutual Fund B without the RBI's involvement at all. The interest rate there is determined entirely by market supply and demand.
Okay, the final money market term is TREPS, Tri-Party Repo Dealing System. Tri-party implies three people. Who is the third wheel here?
Well, as we established, a standard repo is a two-party transaction, Bank A and Bank B. They have to agree on the valuation of the collateral, transfer the bonds, transfer the cash, handle the risk. It's administratively heavy. In a TREPS, a third party, specifically the Clearing Corporation of India, CCIL, steps into the middle to facilitate the whole thing.
So CCIL acts as the ultimate administrator.
Yes. They value the collateral, guarantee settlement, and handle all the operational friction. If you want to lend money safely, you just put it into the TRPS system, and CCIL matches you with a borrower who has provided adequate collateral. It makes it incredibly smooth and secure.
Basically a plug-and-play repo market. Okay, let's shift from the short-term money market to the long-term government securities, or GSEC, market. First term, dated securities.
Dated securities are simply long-term government bonds. They're called dated because they have a specific maturity date that is more than 1 year away, ranging from 5 years, 10 years, all the way up to 50 years. They carry either a fixed or a floating coupon rate, which is the interest paid on the face value.
Next is a really fascinating mechanism, the when issued or WI market.
The when issued market is essentially forward trading in securities before they are officially issued by the government.
I thought about this, and the best way I can visualize it is like pre-ordering a highly anticipated video game. You put your money down, you get a pre-order receipt. But imagine a world where you could trade that pre-order receipt with other people before the game actually comes out.
That captures the essence of it. perfectly.
Really?
Yeah. The government announces on a Monday that it will auction a massive new 10-year bond on Friday. In the intervening days, Tuesday, Wednesday, Thursday, dealers can trade that bond when, as, and if issued.
But why? Why not just wait until Friday?
Price discovery and risk mitigation. If you are a primary dealer mandated to buy hundreds of millions of dollars of this debt, you are terrified of mispricing it at the auction. By trading it in the WI market for a few days, the market collectively discovers what the fair yield of that bond should be.
Oh, so there are no massive shocks on Friday. The auction goes smoothly because everyone already knows roughly what the bond is worth.
Exactly. It prevents a botched auction.
Makes total sense.
Yeah.
Next GSEC term, STRIPS, which is a brilliant acronym. Separate trading of registered interest and principal of securities. This sounds like arcane financial alchemy.
It does, but the underlying concept is actually quite elegant.
Okay, here is how I process it. Tell me if I have this right. It's like taking a fully grown apple tree, which represents the whole government bond. You take that tree and you sell the rights to all the future apples, which are the regular 6-month interest coupon payments, to one guy. And you sell the wood of the tree trunk itself, which is the final principal repayment at the very end of the 10 years, to somebody else.
That is exactly right. Let's map out the math of your apple tree. A standard 10-year bond pays interest twice a year. So over 10 years, that is 20 individual coupon payments, the apples. Plus, you get the massive final repayment of the principal at the end of year 10, the wood.
Okay, 21 separate payments total.
Right. Stripping allows a financial institution to take that single bond, separate those 21 cash flows, and sell them as 21 individual zero-coupon bonds.
But why go through all that trouble to chop up the tree?
Because different investors have highly specific needs. An insurance company might have a massive payout due in exactly 8.5 years. They don't want to receive coupon payments every 6 months and worry about reinvesting that cash at unknown future interest rates. They just want to buy the specific coupon that matures in 8.5 years, lock in their yield, and forget about it. Strips allows them to buy exactly the maturity profile they need.
Custom tailoring the cash flow. I love that one. Okay, let's wrap up our glossary with the regulatory terms. LEI, Legal Entity Identifier.
This is a fascinating innovation born directly out of the ashes of the 2008 global financial crisis. The LEI is a precise 20-character unique alphanumeric code used to track global financial transactions.
So it's basically a barcode for a corporation.
Exactly. Post-2008, when regulators were trying to figure out who owed what to whom, they realized they were totally blind. A single global megabank might operate under 50 different subsidiary names and offshore entities. Regulators couldn't map the systemic risk because they didn't know that Entity A in London and Entity B in Singapore were actually the same parent company.
Oh, wow.
So the LEI forces every corporate entity trading in financial markets to have one unique, globally recognized barcode. It gives regulators a panoptic view of the risk.
And finally, ETP, Electronic Trading Platform.
These are electronic systems authorized by the RBI that facilitate the trading of eligible financial instruments. Historically, a lot of trading happened over the phone, bilaterally. The goal of mandating authorization for ETPs is to force trading away from opaque phone calls and onto transparent, regulated digital screens. It improves price discovery and leaves an indelible digital audit trail.
Okay, so we've covered the history and we've learned the vocabulary. But who is actually enforcing all this? We know the RBI is the central authority, the architect. But the sources highlight a network of critical institutions that do the heavy lifting day to day. So important figures and names. Let's look at the framework builders.
The most critical piece of market infrastructure mentioned in the text, without a doubt, is CCIL, the Clearing Corporation of India Limited, established in 2001.
Right. The sources highlight its role as a central counterparty, or CCP, and a trade repository. You mentioned a concept called novation earlier when we talked about tier FPS. I really want to dig into that because when you describe it, it sounds almost like magic. But I'm highly skeptical. Let's walk through the mechanics.
It is the ultimate risk management mechanism. Let's set the stage. Imagine Bank A agrees to sell $100 million to Bank B in exchange for Indian rupees. In a normal bilateral world, Bank A assumes a massive risk. What if Bank B goes bankrupt tomorrow and fails to deliver the rupees, but Bank A has already sent the dollars?
That's a disaster for Bank A. And if Bank A takes that hit, they might default on a loan they owe to Bank C, and suddenly the whole domino line falls.
Precisely. That is systemic contagion. Novation is the legal process that breaks that chain of dominoes.
Uh,
The moment Bank A and Bank B agree to the trade, CCIL steps right into the middle and effectively tears up that original contract.
CCIL just nullifies it.
Yes, and CCIL immediately replaces it with two new contracts. CCIL agrees to buy the dollars from Bank A, and CCIL agrees to sell the dollars to Bank B. CCIL legally becomes the buyer to every seller and the seller to every buyer.
Okay, hold on. This is why I have to push back. I understand that Bank A is now happy because their contract is with CCIL, which is rock solid, instead of Bank B. But haven't we just moved the ticking time bomb? What happens if Bank B defaults? Now, CCIL is left holding the bag for $100 million. If CCIL is the buyer to every seller in the entire country, aren't they absorbing an unimaginable amount of risk? If CCIL fails, the whole economy evaporates.
That is the exact right question to ask. Yes, CCIL concentrates the risk, but they do not just absorb it blindly. They manage it through an incredibly aggressive, mathematically rigorous system of margins and default funds.
How does that actually work?
CCIL doesn't let anyone trade for free. Before Bank A and Bank B can even execute that trade, they both have to deposit significant collateral called initial margin with CCIL. It's a massive security deposit. Furthermore, every single day, CCIL recalculates the value of the trade. If the currency moves against Bank B, CCIL demands more collateral immediately, called variation margin.
So they are constantly keeping the account topped up.
Exactly. So in your scenario, if Bank B defaults and disappears, CCIL already holds enough of Bank B's collateral to cover the $100 million loss. The system is entirely pre-funded. And even if the loss exceeds Bank B's collateral, CCIL has a massive default fund contributed by all members. It is a fortress designed to withstand the simultaneous default of its largest members.
Okay, that makes me feel slightly better. It's not magic, it's just incredibly strict pre-funded insurance. Let's move to the next institution, FBIL. Financial Benchmarks India Private Limited, promoted jointly in 2015.
Their mission is singular but vital: to administer crucial financial benchmarks transparently and accurately.
The sources mention benchmarks like MIBOR, the Mumbai Interbank Outright Rate, and the USD-INR reference rates. Now, to understand why FBIL was created in 2015, we really have to look globally, right? I'm thinking about the massive LIBOR scandal in London.
You absolutely have to look at the LIBOR scandal. For decades, global interest rates were tied to LIBOR, which was basically calculated by asking a bunch of banks, hey, at what rate do you think you could borrow money today? It was based on estimates. And shocker, traders at these banks conspired to lie about their estimates to manipulate the rate and make millions on their derivative trades.
Because if trillions of dollars in mortgages and corporate loans are priced at LIBOR plus 2%, moving that benchmark by even a fraction of a percent is worth an absolute fortune.
Exactly. It was a massive breach of trust globally. India watched that happen and recognized the vulnerability of benchmarks. FBIL was established as an independent administrator to ensure that Indian benchmarks like MIBOR are not based on subjective estimates, but are calculated based on actual, verifiable, executed transactions in the real market. It completely removes the human element of manipulation.
Love that. The final group of institutions are the SROs, the self-regulatory organizations. The text lists three big ones: FEDI, which is the Foreign Exchange Dealers Association of India, FEMMDA, the Fixed Income, Money Market, and Derivatives Association of India, and PDAI, the Primary Dealers Association of India. Now, these organizations represent the market participants themselves, the banks and the dealers.
Yes, they are essentially industry bodies.
Which naturally leads to a massive question. We just talked about how banks will manipulate benchmarks if left to their own devices. So why does the RBI delegate so much regulatory power to these SROs? Isn't that the literal definition of letting the foxes guard the henhouse? Why not just have the RBI write every single rule and code of conduct?
It's a valid concern, but it comes down to the sheer speed and complexity of modern finance. The reality is a central bank, no matter how well resourced, simply cannot write the micro rules for every single new derivative contract, every new trading software, or every new market convention. If the RBI tried to do that, regulation would move at a glacial pace and innovation would completely stall.
The market would outrun the regulator.
Always. The market participants, the actual dealers sitting on the trading floors, they have the granular day-to-day expertise required for agile rulemaking. They know exactly where the operational friction is.
So how does the RBI keep them in check?
It's a tiered system. The RBI sets the macro boundaries, the prudential framework. They say, you must hold this much capital, you cannot take this much risk. Within those strict boundaries, the SROs develop the operational codes of conduct. They standardize the legal documentation so everyone is trading on the same terms. They even act as arbitrators for minor trading disputes. It is a collaborative, delegated model. But the RBI is always watching. If an SRO's rules threaten systemic stability, the RBI has the statutory power to intervene and overrule them. It's delegated authority, never abdicated authority.
That makes a lot of sense. The RBI builds the highway and sets the speed limit. The SROs decide what side of the road to drive on and how to use turn signals. Okay, let's pivot to the hard numbers. Let's extract the vital statistics and empirical data from the chapter. These numbers are critical because they illustrate the sheer, terrifying scale of what we're talking about.
The numbers provide the necessary context to understand why this regulatory architecture has to be so robust.
First data point, 4x turnover growth. The average daily turnover in the Indian foreign exchange market jumped from about $5 billion in 1998 to a staggering $83 billion in 2023.
That is nearly a 16-fold increase in daily volume over 25 years. We aren't talking about annual GDP here. We are talking about $83 billion changing hands every single day.
What drives that kind of explosive growth?
It reflects the massive structural opening of the Indian economy to the world. It's the surge in foreign direct investment pouring in to build factories. It's the massive IT services sector repatriating billions in foreign earnings. It's the deep integration of Indian corporations into global supply chains. A $5 billion market is relatively easy for a central bank to manage and intervene in, but an $83 billion daily market is a behemoth. It requires highly sophisticated automated surveillance, incredibly deep liquidity pools, and flawless digital infrastructure to prevent bottlenecks.
Second data point, G-Sec tenors. The sovereign yield curve in India now spans up to 50 years.
We should pause and really think about the psychology of a 50-year bond. For a government to issue debt that matures half a century from now, and for investors to actually willingly hand over their cash to buy it, requires an immense, almost profound level of institutional confidence.
Honestly, it sounds crazy to me. I don't know what the world is going to look like in 5 years, let alone 50. Given inflation, political changes, global crises, wars, who in their right mind takes a 50-year bet on a single government's currency?
It sounds crazy to an individual retail investor, yes, but you aren't the target demographic. Think about a massive pension fund. A 20-year-old worker starts contributing to their pension today. That fund has a legal obligation to pay out a fixed retirement income to that worker 45 or 50 years from now.
Okay, they need to match the timeline.
Exactly. They have ultra-long-term liabilities. They need ultra-long-term assets that provide mathematical certainty of return. A 50-year sovereign bond is exactly the instrument they need. And from the government's perspective, it provides them with locked-in capital to finance massive, multi-decade infrastructure projects like high-speed rail networks or nuclear power plants, without constantly worrying about having to refinance short-term debt every few years. It's a sign of immense macroeconomic maturity.
Third data point, FPI investment limits. Foreign portfolio investors are currently capped at 15% of the outstanding stock of corporate bonds under the medium-term framework.
This specific percentage highlights the tightrope the RBI walks. On the developmental side, they desperately want foreign capital to flow in and help deepen the corporate bond market, making it easier for Indian companies to raise money, which is why they opened the door to FPIs.
But they only opened at 15%. Why not 50%? Why not 100%?
Because of the regulatory side of their mandate, stability. Foreign portfolio flows are notoriously fickle. It is often referred to as hot money. An FPI sitting in New York or London might buy Indian bonds today because the yield is attractive. But if the U.S. Federal Reserve suddenly raises interest rates next month, that FPI might decide to dump all their Indian bonds simultaneously and move their capital back to the U.S.
And if they own 50% of the market, that massive sudden exit would cause a total collapse in Indian bond prices and send the rupee into a tailspin.
Precisely. It would induce massive artificial volatility. The 15% cap is a macroeconomic guardrail. It allows enough foreign capital in to provide liquidity and development, but ensures that the bulk of the domestic debt is held by domestic institutions, insulating the Indian economy from external shocks.
And the final specific statistic from our glossary section, just to reiterate the precision required, the LEI is a precise 20-character unique alphanumeric code.
Right, and if we connect all these data points to the bigger picture, they tell a unified story. The $83 billion daily Forex volume, the 50-year time horizon, the intricate balancing of 15% FPI caps. They represent an economy that is scaled massively and integrated deeply with global capital flows. And scale demands data-driven, hyper-precise oversight. That is exactly what the 20-character LEI and the electronic trading platforms provide.
Which flows perfectly into understanding the why behind the regulations. We are going to map out the cause and effect relationships discussed in the text. This is where we see the RBI's regulatory philosophy in actual practice. They don't just invent rules because they like bureaucracy. They react to structural vulnerabilities.
They are essentially identifying points of failure in the plumbing and designing specific, targeted valves to fix them.
Let's look at the Forex derivative market. The problem, the cause, was that large, lumpy capital flows and global geopolitical events were creating extreme volatility in the value of the rupee.
And currency volatility is deadly for real economic growth. It makes importing and exporting a massive gamble.
So the RBI deployed a specific regulatory effect. They mandated that if you want to trade over-the-counter foreign exchange derivatives linked to the Indian rupee, you must have documentary evidence of a valid underlying exposure. How does this actually solve the volatility problem?
It solves it by deliberately curbing pure speculation. Let me paint a picture. Suppose you are a large Indian manufacturing corporation. You know you need to import $10 million worth of heavy machinery from Germany in exactly 6 months. You have a valid underlying exposure to currency risk. If the rupee depreciates violently over the next 6 months, that machinery becomes catastrophically more expensive for you in rupee terms.
Your profit margin completely vanishes.
Right. So the RBI encourages you to go to the derivative market and buy a forward contract to lock in the exchange rate today. You are hedging a real-world commercial risk. That is healthy market activity.
But what if I'm not a manufacturer? What if I'm just a giant hedge fund operating offshore, and I have a strong feeling that the rupee is going to crash next month? I want to buy a massive derivative contract simply to place a bet and make a quick profit. I have no underlying exposure.
Exactly. And the RBI historically restricted that kind of purely speculative OTC trading for a very specific reason. When massive amounts of speculative hot money pile onto one side of a currency trade, billions of dollars betting against the rupee, that sheer volume of trading can actually cause the rupee to crash. It becomes a self-fulfilling prophecy.
Wow.
Yeah, it creates extreme artificial volatility. By legally requiring proof of actual commercial exposure, the RBI ensures that the derivative market serves the real economy, the manufacturers and importers, rather than acting as a global casino that destabilizes the national currency.
It's forcing the market to be a tool for commerce, not just a gambling table. I love that. Let's look at another problem. This one affects everyday people directly. The cause. Retail customers and small businesses were facing totally opaque pricing and very high costs from their banks when exchanging foreign currency.
This is a classic problem of information asymmetry.
Right. Before this regulation, if a small business needed to buy euros to pay a supplier, they went to their bank. The bank looked at their screen, saw the real wholesale interbank rate, and then quoted the small business a much higher rate. The business had no idea how massive of a markup the bank had baked into that quote.
The bank was capturing a massive hidden spread because the customer was blind to the true market price.
So the RBI deployed a solution, the FX retail platform. What did this actually achieve?
It forced daylight into the process. By facilitating the creation of the electronic FX retail platform, the RBI mandated transparency. Now, authorized dealers, the banks, are required to disclose the mid-market marks. A retail user or a small business can log onto the platform, see the actual real-time wholesale market rates, and clearly see the exact fees and markups the banks are trying to charge.
It strips away the bank's informational advantage.
Exactly. It democratizes access to fair pricing. The banks are forced to compete on transparent fees rather than hiding behind opaque exchange rates.
Let's revisit a problem we touched on earlier, but look at it through this cause and effect lens, the cause. The government needs to borrow massive, unprecedented amounts of money by issuing bonds, but they need to absorb this debt into the market without causing auction failures or massive yield spikes.
A failed sovereign bond auction is a terrifying signal to global markets. It suggests the government cannot fund itself.
So the RBI deployed the when-issued, the WI market.
Yes. The consequence, as we discussed with the pre-order analogy, is that the distribution period is stretched out, and true price discovery happens before the gavel falls at the actual auction. The primary dealers use the WI market to gauge exactly how much appetite there is and at what yield investors are willing to buy. When the auction day arrives, the massive influx of new government debt is absorbed smoothly because the market has already digested the pricing over the preceding days. Uncertainty drops significantly.
And the final major cause and effect scenario takes us back to the 2008 global financial crisis, the cause. 2008 exposed the hidden catastrophic risks of bilateral, non-cleared trades between massive financial institutions.
This is the scenario where CCIL cannot save you. We talked about how CCIL acts as a central counterparty for standardized trades, but not every derivative contract can be standardized. The OTC market is huge. Corporations and banks often need highly bespoke, customized derivative contracts that are too complex to be cleared through a standardized hub like CCIL.
So these bespoke trades remain bilateral. It's just Bank A and Bank B operating in the dark.
Correct. And what 2008 showed the world was that when Bank A, say a Lehman Brothers, goes bankrupt overnight, Bank B is suddenly left holding billions of dollars of worthless derivative contracts. This massive, unexpected loss might cause Bank B to fail the next day. That is the ultimate domino effect.
So how did the RBI regulate a market they can't force onto a clearinghouse?
The RBI deployed a strict mandate: the exchange of initial and variation margins for non-centrally cleared OTC derivatives.
They forced bilateral trades to adopt the CCIL model of security deposits.
Precisely. They said, fine, you can trade these bespoke contracts bilaterally in the dark, but you must post collateral initial margin upfront with each other. And as the value of the contract fluctuates daily, you must exchange additional collateral variation margin.
So if things go south and Bank A goes under, Bank B already physically holds the collateral to cover their loss.
Exactly. It forces these institutions to pre-fund their potential losses with each other. It drains a lot of liquidity out of the system because all this collateral is locked up. But the consequence is a dramatic systemic reduction in credit risk and the prevention of contagion. It is a massive firebreak.
It's incredible how every rule is essentially a scar from a past crisis. To help organize all these different structures, let's build a mental matrix. We need to categorize the opposing viewpoints and varying market structures mentioned in the chapter. Let's contrast how things operate.
Contrasting the models is the best way to synthesize the landscape for sure.
Start with the big one, OTC, over-the-counter markets versus exchange trade markets. On the OTC side, the contracts are bespoke. They are heavily customized to the specific needs of the participants. It is primarily an institutional market. You don't see retail investors here. And trades are settled either bilaterally, like we just discussed, or via a central counterparty if they are standardized enough. My analogy for the OTC market is going to a high-end tailor for a custom suit. You pick the exact fabric, you get your precise measurements taken, you dictate the cut of the lapel. It's a private negotiated transaction. It fits your exact, unique risk profile perfectly, but it's expensive, and you can't easily sell that custom suit to someone else.
That is an excellent way to conceptualize OTC. Now let's contrast that with how things happen on the exchange-traded side. These contracts are highly standardized. You can't customize them. The pricing is completely transparent, flashing on a public screen for everyone to see. Because of this standardization and transparency, they are highly accessible to retail investors, and they are settled on formal exchanges, which operate under the operational oversight of the Securities and Exchange Board of India, SEBI. To continue your analogy, the exchange-traded market is buying a suit off the rack at a department store. You can't customize the sleeve length of the derivative contract. You just pick from the standard sizes available: small, medium, large. But the massive advantage is that anyone can walk in and buy it instantly at a known public price, and you can easily sell it back to the store if you don't want it tomorrow. It provides massive liquidity.
Perfect. Now let's contrast the primary versus the secondary government securities markets. In the primary market, this is where the government is actually raising new funds to build roads and pay salaries. The defining mechanisms driving this market are the electronic auctions conducted by the RBI and the when-issued forward trading we broke down earlier. Money flows from the investors directly into the government's coffers.
On the flip side, look at the secondary market. This is where existing, already issued debt is traded between investors. If you buy a 10-year bond in the primary market but need cash after 2 years, you sell it in the secondary market. No new money goes to the government here. It just changes hands between market participants. The defining mechanisms driving the secondary market are massive electronic platforms like the NDS-OM, the negotiated dealing system order matching, which handles the wholesale institutional trades, and the newer retail direct scheme for individual investors.
And finally, let's contrast the core concept we started with: the RBI's dual role, development versus regulation. On the developmental side of the ledger, the RBI acts as an innovator and a builder. Their actions focus on introducing new products to make the market deeper, like introducing strips and credit default swaps. It focuses on expanding access, like carefully allowing foreign portfolio investors into the corporate bond market to provide capital, or creating the retail direct platform to bring in everyday citizens. And it focuses on building hard, robust infrastructure, like promoting the creation of CCIL to handle clearing.
And on the regulatory side of the ledger, the RBI acts as the strict guardian. Their actions are restrictive and protective. They are prescribing strict prudential norms, dictating exactly how much capital a bank must hold against its risky assets. They are enforcing market abuse regulations, which they tightened significantly in 2019 to prevent the kind of benchmark manipulation we saw with LIBOR. And they are mandating reporting to trade repositories via LEIs to ensure the central bank has a constant panoptic view of systemic safety.
Development steps heavily on the gas pedal. Regulation constantly upgrades the brakes.
Exactly. And if you are driving an economy of 1.4 billion people at high speeds, you absolutely need both to navigate the terrain safely.
So what does this all mean for you, the listener? We have taken a tremendously dense, technically heavy chapter on the development and regulation of financial markets, and essentially unpacked its mechanics into an exhaustive blueprint. We've seen the historical narrative, how India transitioned from a repressed, command economy financial system where the government dictated everything to an open, globally integrated powerhouse driven by price discovery.
We've traced the timeline of that liberalization from the foundational committees of the 80s to the terrifying crisis of 1991 to the infrastructural modernization of the 2000s. We decoded the essential, intimidating vocabulary of money markets and government securities. And most importantly, we highlighted the critical institutions like CCIL that act as the shock absorbers, keeping the gears turning without catastrophic failure.
We looked at the massive growth numbers, from $5 billion to $83 billion a day, and analyzed how past crises forced the RBI to build better, pre-funded regulatory firewalls. It really is a living story of an economy aggressively opening its doors to the world while meticulously, almost obsessively, building a fortress of infrastructure to protect itself.
And it is vital to remember why we spent this time dissecting it. Terms like tri-party repo dealing systems, novation, and over-the-counter derivatives sound like the exclusive, walled-off playground of billionaires and giant multinational banks. But they are not abstract concepts. These markets are the very engines that determine the value of the money in your pocket today. They dictate the inflation rate you experience at the grocery store. They determine the interest rate you will pay on a 30-year mortgage. And they ensure the ultimate security of your pension fund tomorrow.
The plumbing matters to everyone who drinks the water. Which brings me to a final forward-looking thought based on everything we've read in this text. We spent a lot of time talking about how these markets were built for massive institutions. But look at the most recent innovations mentioned: the RBI Retail Direct Scheme and the FX Retail Platform. These platforms are specifically designed to bypass the traditional intermediaries. They're designed to bypass the big commercial banks and give you, the individual listener, direct access to wholesale sovereign bond yields and transparent foreign exchange rates.
It is a profound, almost radical democratization of financial access. Historically, retail investors were kept far away from the wholesale markets.
But it raises a massive question for you to ponder as we wrap up. If this trend continues, are we approaching a future where the traditional wall between institutional megamarkets and everyday retail banking completely dissolves? If you, an individual, can log on to a government app and trade 50-year sovereign debt directly on the RBI's platforms, sitting right alongside the giant primary dealers and pension funds, what eventually happens to the traditional banking system?
It forces us to ask what the core value proposition of a traditional retail bank will be in a fully disintermediated, digitized future where the central bank offers direct access.
Exactly. When the murky, complex waters of high finance are finally filtered and made transparent, and you can swim directly alongside the massive institutional whales, the entire ecosystem has to adapt. Something to mull over as you digest this deep dive into the financial tracks. Thanks for joining us.